welcome back now for commodities market update. Now, see, annual inflation in Nigeria dipped in December 2022. Saw that decline there about 21.34% after 10 straight monthly increases. But what can we expect in January? That's the question now. Joining us is Oluwatomi Maiwa, analyst, financial derivatives company. Join us via Zoom. Great to have you.
Thank you very much, Ladi, for having me.
So, Toby, definitely January was a very challenging month, you know, with the Naira swap, fuel queues, and it looks like inflation will tick up again. Break down your expectations.
Yeah, typically, coming from December, a month where the festive period usually, help to boost demand, and then January, where all of those things are, reduced. So typically, we should see inflation actually decline, of which we even saw the other way around in December, because typically demand would actually increase during the festive period. But we are in unusual times right now, and considering the fuel scarcity, that will lead to increased transportation costs, the cash squeeze, and that situation, should lead to a decline in demand, because nobody really, you don't have the money to, go to the market to buy something. So theoretically, we should see demand, fall. But when we look further into the nature of the good, goods in terms of, looking at elastic goods and goods that are, perishable and inelastic. When I mean elastic, that means talking about the price, the demand for that particular good, responds more to, that's for elastic, respond more to prices. And then for inelastic, the demand for that good, respond less to price changes. But, because for inelastic good, it is, quite easy to pass cost to consumers, because, you have to just buy it. For example, rice, for example, beans and all of that. So because it's easy for them to pass the cost to consumers, irrespective of the cash squeeze, we still saw an increase in all of those commodities. But why for perishable goods like tomatoes, for this pepper and all of that, we saw that that's the price declined, because you just have to sell the product before they start to get spoiled, and considering the cash squeeze in the system. So all of those things, we saw that this would actually lead to an increase in inflation rates, coupled with the fuel scarcity and the increase in transportation costs. So we're projecting about 21.42% in January.
21.42, and obviously we know central bankers globally, they've been echoing the same thing. If inflation ticks up, they will take rates even higher. And obviously, everyone's going through a lot right now. What are you seeing for MPC policy going forward? And is a rate hike really what we need right now?
Well, let me say there are a lot of uncertainties in the air right now. And it's not quite clear what the CBN will be doing, the MPC will be doing I think the next meeting they'll be having will be March. Because one, T-bill rates, which should always move in tandem with the monetary policy rates. We saw that after the meeting, the rates fell, there was that divergence, right? So it's at the moment, things are still, quite unclear. So what we think should happen in the short term is the fact that T-bill rates would, increase further. So once T-bill rates increase further, I would see that it will help to mop up liquidity in the system. So basically, it's about bringing the effective rates, to the monetary policy rate. That means raising the T-bill rate to reflect, the tightening stance of the CBN. So I think that's what we're going to see in the short term. But for the MPC meeting, there's still a lot of uncertainties right now. So there's only little we can say at the moment, but we don't see them. We don't see anything at the moment.
And obviously with, other economies, there are parameters they measure to see the impact of, the previous rate hikes. Well, what do we have here in Nigeria to say, okay, we're seeing the impact, of the 600 basis points we've done already? Like, what parameters are there to measure here?
Well, I can say, first of all, the nature of inflation, inflationary pressure is mainly cost push. So it's although there's a demand pull aspect, but compared to the cost push side, I think that's where that's the nature of the inflation rate, and that's why even in sub-Saharan Africa, we've seen that even though global inflation is slowing, but in sub-Saharan Africa, we've seen that inflation has been tapering, at a slower pace compared to the global economy because of the structural problems that are attached to inflation in sub-Saharan Africa. So basically, I think one of the issues in Nigeria is the structural problems that is attached to the inflation problems. For example, the fuel scarcity, the increase in transportation costs, then the depreciation of the naira, definitely, and like I said, the last time I was here, I said that manufacturers are now pricing their products, with what they see in the parallel market because they are no more receiving as much as they used to do as our last 2 years ago, that 2021. So it's been quite difficult. So that's why there's that divergence from the global trend to some extent. So I think that's why we're still seeing that pressure in the economy.
All right, let's look at the oil market because I know that contributes to inflation globally. What are we seeing there? We've seen a price increase for the week. There's a positive right now talking about the prices, but how are you seeing it right now? What's driving sentiment? What can we expect for next week?
Well, like I said the last time, that there's a long-run outlook for oil, which relatively stands about the demand for from China, considering the fact that there's an elimination of their zero COVID policy, and their demand or their GDP growth is expected to rise to about 5% from about 3% last year. So there's that optimism in the market, even though considering that we expect activities to slow in the US. I think recently they've been having increased inventories of their reserves. So that's actually to some extent supporting the bearish sentiment in the market. But, as usual, but that's why I said the long run is still on the improved demand from China, although because considering the fact that China is the second largest economy. So that on the long run is helping to support prices, crude oil price around $80 per barrel. And so that's what we're going to see going forward.
And obviously, we're still seeing that volatility with LNG in the global market. Are we still going to stay down, with those prices?
Yeah, let me say for now, there's no cause for alarm because there's been less depletion on the inventories for gas. Considering the fact that the weather has been not been so bad as as earlier predicted, and the fact that the alternatives of the European countries are actually sourcing for gas from alternative places. So and the price of gas at the moment, or natural gas at the moment, is actually far below what it was even at the start of the war. So right now there's no cause for alarm, and that's why we're still going to see the price of gas, stay around $2 per MMBTU to around 2.5, 2.6. So on the short term, that's what we're going to see.
Oh, it's quite incredible that LNG was trading above close to about $10 sometime, and yes, most of these prices have come so low at this time. But it is good news, for the inflation story.
Let me say it's good news for them for European countries because that's always a major stoking factor for inflation. But and it's bad news for Nigeria because it's constitute about 14% of our total exports, and so that would actually reduce our external earnings, and definitely we'll see the pressure on the naira at the end of the day. And also for although that shortfall might be covered by the higher oil price, but at the end of the day, it's what our oil production is. It's not up to total, not up to what the OPEC quota is, and so it's
Yeah, bad for
news.
earnings, good for inflation. All right, thank you so much. That was Oluwatomi there giving us the details from the commodities market analyst, financial derivatives company. Thank you so much.
Thank you very much.